Hello, this is Kelvin Leibold, Area Farm Management Field Specialist in North Central Iowa, with our fourth in the series of programs on farm leasing arrangements in Iowa. Today we're going to talk about the farm program payment and how those programs impact rents. That's been a topic that is of interest to many people. We take a look at the Farm Bill came out in 2014. In Iowa, there was three different choices, but the most popular one was Ark County. Over 98% of the producers in the state selected the Ark County program. These program payments have been capitalized into the rents. Under the old program of direct payments, it was pretty easy to go in and find out the corn base or bean base on the old farm and the yields that they had. And then one could just simply dump them into the formula and calculate the payment rates. If that farm had 100% corn base, that a typical farm in Franklin or Hardin County might receive maybe $34 in base payments. If they only had a 50% corn base, then a farm might only receive $24 in payments. So if you had two identical farms, one getting a payment for $24 an acre from the government, the other farm getting a payment for $34 an acre. The landlord owned the farm that got $34 an acre. He should do what? Well, he should charge $10 an acre more rent because, well, the producer really wasn't paying that. So historically, those prices have been captured into the rents, and so the government program payments have really been a land subsidy program, much more so than a producer subsidy program. Well, the same thing has continued on here from 2014, in that when we went to sign up for the 2014 Farm Bill, we were pretty comfortable in thinking that we were going to get some significant payments out of the Ark County program for 2014 and 2015 crop years. A little bit of history on how these programs are calculated. You start off with an Olympic yield. So for the 2014 crop year, which was the first of the farm program, we went back and looked at the 5 previous years. So we would take and throw out the low yield. Low yield looked like for Hardin County was 156 bushels. We'd throw out the high yield, I think that's 187. We'd use the other 3 and average them to come up with 169. We'd do the same thing on the marketing year price. Now, the marketing year price is a cash price, but it's a cash price for the whole nation, and it runs the marketing year. So for the 2014 crop that we harvest in the fall here, a crop of corn or soybeans, we would start September 1 of 2014 and keep track of the price of corn for the next 12 months until the end of August of 2015. Then in October of 2015, we would make the 2014 payment. So it's always a year behind. So to come up with the 2014 Olympic price of $5.29, we threw out the 2009 year, we threw out the $6.89 for 2012, used the $5.18, the $6.22, and the $4.46. Well, and then in 2015, we just moved back 1 year, so we used, we got a $3.70 for the 2014, 2015, so we throw that one out, use the same 3 years, so we ended up with the same Olympic price. Okay, so once we've established the Olympic yield and the Olympic price, then we can get to the gross revenue guarantee. So by multiplying those two numbers together. Now, the government didn't want to insure 100% of the risk, so there's a 14% deductible. That gets us down to our net revenue guarantee. So instead of having $894 of gross revenue guarantee in 2014, we only had $768. The other thing the government didn't want to do is it didn't want to pay for all the loss. So not only did you have a deductible, but you also had a cap on the amount of payment that they would make. So you were capped out at 10% of your gross revenue. So if you took 10% of $894, you come up with about $89. That's the maximum payment the government was going to make, no matter how much your loss was. Well, how did you determine your loss? Well, you take a look at your actual revenue. So we wait till after the year is over and we get a county yield established. So we ended up with 163 bushel as being the county yield for 2014. and we've got the national marketing average price of $370. Multiply those together, that gets you your actual revenue. So then you take your actual revenue against your net revenue guarantee, and you find out you had a $165 loss. Well, all right, you can get paid on all that? No, we capped out. We capped out at that 89. Do you get paid on every corn base acre? No, you only get paid on 85% of your corn base acres. So we got to multiply 85% times $89 to come up with the $75 payment. Well, then we also have sequestration, which is a requirement that the government cut their budget. So we lose another 7%. So we ended up with a final payment of about $70 per corn base acre. Okay. So in 2015, we're going to do the same thing. It's almost the end of August here when I'm recording this. So we don't quite know the 2015 marketing year price, but we're pretty sure it'll be within a nickel of that $3.65. We don't know the county yield yet because that's the official USDA yield, but there's some adjustments for prevented planting or non-harvested acres. So again, this is an estimate there, but by and large you can see that first 3 years of this program, based on our current estimates, that we're going to have some pretty substantial payments, and then we're going to have payments drop off. Okay, so they could have signed up for the PLC program, but you know, the idea that I've got a payment today rather than one maybe in the future, a bird in hand is worth more than two in the bush. So we're faced with this challenge of declining government payments, declining government prices. So when a tenant gets his rent reduced by $30 and his government payment declines by $40, they really haven't made much progress towards profitability. There is a URL link at the bottom of the page there that you can go to get more background information on how this program is calculated. Taking a look at 2016 estimated payments, you can go across and look at Wright County at $27, Franklin County at $46, and Butler at $73. People are looking at this going, now how can that happen? How can we have that much variability within 30 miles of each other? And the answer is well, this is a county-based program based off of those historical yields, and so it doesn't matter what the yield is on your farm, doesn't matter how productive your farm is, everybody gets paid the same in that county. Now if you're farming in two counties, then you can pick your county that's your priority county, where your county of record is, and maybe get a higher payment rate. The other thing you notice that is in southern Iowa, some of those areas of the state that traditionally need more help than others had large yields in 2015, wiping out all their farm program payments. As a matter of fact, there may be some counties in Iowa that don't get a farm program payment for the whole life of the farm bill. If we take a look at beans, 2016 will probably not treat North Central very well. We're going to have a lot of farms that have low bean bases, and that will help as compared to having a higher corn base, so their payments will be based on their ratio of corn to beans, but nonetheless beans are not going to pay very well in 2016 the way it looks. So here's the URL if you want to download this spreadsheet. There's the county tab. You can go up here and click on the yellow box. A drop down menu will appear and you can pick one of the other 98 counties and work your way through, and we'll update this periodically so that we finish out here by October. We'll have the 2015 year finished out, and we'll start to make some estimates on prices on 2016 as well. I'd like to talk briefly about crop insurance, tool to manage risk. Most of the crop insurance sold in Iowa is a revenue insurance, so it's based both off of a yield and a price. I just grabbed some typical, what we call actual production history numbers. So the NASS says the Hardin County 5-year yield is about 175. These are based off of 10 years worth of yield data to get your what we refer to as APH. So maybe we use a 180 bushel farm. If we take a look at the 2016 spring price, I refer to it here as the March price, but it's really the average for the month of February for the December 2016 futures contract. So this is a futures price, not a cash price. Comes out in March, but it's based off of the February average for the December futures. Anyhow, if you took that price times your APH, you'd come up with some potential insurance revenue level. The highest level coverage that I can buy is 85%. So if I bought the 85%, I'd have about $590 worth of coverage. Back in 2012, when you look at those prior prices, you can see that I could get up to $800 worth of coverage. So if I went out and had $500 in expenses and paid $300 in rent, I really didn't have any risk. Okay, so as a matter of fact, even if I paid $350, I maybe only had to assume $50 of risk. And if I was at a top producing farm over here, why, that was even less. Taking a look at what 2017 looks like we're going to have some lower prices. This is the price of the December 2017 futures contract. Have no idea what it'll be when we actually get there, but just if this turns out to be the case, you'll see that I have lower dollars of coverage. So again, looking at $590 of coverage dropping down to $527 of coverage, my producers are going to assume more downside risk. They can't pass that off to anybody else. That'll be another cause for concern and another factor in driving rents lower. Well, that concludes our little bit on the farm program payments. Again, on the Ag Decision Maker website, there's a lot more information along with several other sites. So we'll be back with our ongoing program in our series here with session 5, which will be on the cost of production. Thank you.